problem 12.9 on page 431 is just like problem 12.8. So we'll follow a lot of the same methodologies that we followed in problem 12.8 to solve 12.9. Just like 12.8, I'm going to break this into three parts. And part number one is going to be calculating initial investment outlay. So let me read the problem. It says you must evaluate a proposal to buy a new milling machine. The base price is $108,000, and shipping and installation would add another $12,500. The machine falls into the maker's 3-year class, and it will be sold after 3 years for $65,000. The depreciation rates are 33%, 45%, 15%, and 7%. The machine would require a $5,500 increase in net operating working capital. There will be no effect on revenues, but pre-tax labor cost would decline by $44,000 per year. The marginal tax rate is 35%, and the weighted average cost of capital is 12%. Also, the firm spent $5,000 last year investigating the feasibility of using the machine. Part A wants to know, how should the $5,000 spent last year be handled? Recall that that's considered a sunk cost, and sunk costs do not figure in to the cash flow estimation process in trying to buy this new machine. So this $5,000 that was spent last year is completely out. You won't see it show up anywhere in this analysis. As for the initial investment outlay, the asset has a base price of $108,000, installation costs of $12,500, and an increase in net operating working capital of $5,500. Therefore, my initial investment outlay is $126,000. Remember, out of this, only the base price and the installation are depreciable. This is inventory and accounts payable, it says. Both of these are current assets and current liabilities. They're non-depreciable. So my depreciable basis is going to be $108,000 plus $12,500 or $120,500. That'll be important in part two. Notice up here I've updated the timeline. I've put my initial investment outlay minus $126,000 into the timeline at time 0.